Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute for August 25th, 2013. The markets managed to survive the reading of the Holy Scriptures last week, otherwise known as the minutes of the Federal Reserve's Monetary Policy Committee. There was the usual volatility around the sacred chanting, with prices soaring and then selling off, until by the end of the day, a broad-ranging consensus had emerged that no one could agree on exactly what the minutes meant. So far as I could tell, the Fed could still go either way, which is probably what it wants us to think. Be prepared, but we're still not committed. The part about the minutes that bothered me was the sensation that the Fed is trying to thread a needle with an anchor chain, all the while being afraid to hurt the needle's feelings. At any rate, by then the markets were sufficiently oversold to begin the usual late August rally. It was spurred on by the astonishing revelation that China's PMI survey, or Purchasing Managers Index, showed no change in trend from the previous month. Fortunately or unfortunately, most of the business press doesn't really understand how diffusion surveys work, so the change from 47 something, which showed a decline from the previous month, to a level of 50 showing no improvement, was taken by most writers to signify a major expansion in Chinese activity. Add to that a Eurozone services reading, PMI, of 51, and both Bloomberg and CNBC were soon talking about the global economic rebound. Well, that was enough to get the markets moving back up again. So unless something goes very wrong over the coming week, we should be clear to keep going and finish the month with the usual late August rebound. One that rates to last through next week as well, or at least until the next big piece of news shows up in the form of the jobs report on Friday, September 6th. A bit of news that helped out last Friday was the market catching a glimpse of Goldilocks in her dress again. The July report for new home sales came out, and not only was it well short of expectations, but month to month it showed a 13% decline in the seasonally adjusted annual rate. So maybe the Fed isn't going to be so quick to taper after all. Certainly the central bank has talked an awful lot about the importance of housing to the recovery. The decline could be a consequence of higher rates, but I really think it's more about home builders adjusting supply to conditions. The average price rose sharply, and the decline in sales was concentrated in houses that sell below $200,000. The week ahead is part of what I call the market's silly season, when it floats up on very low volume, very little news, and nice weather. The outlook is for a week of mostly beautiful weather in New York City, so I expect traders to be feeling the love. I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.